Hello Mindsetters, and welcome to another Learn Extra show for Grade 11 Accounting. Today's topic is going to be partnerships, and in particular the interpretation of partnership financial statements. Now, this is a very, very important section that you need to learn and that you need to master, and it builds on your grade 10 work where you did the interpretation of financial statements for a sole proprietor. Grade 11 builds on it, just makes it slightly more challenging, slightly more complicated, including the financial ratios for a partnership instead of for a sole proprietor, and then in Matric we're going to extend the same analysis to companies. So many of the ratios that I'm going to talk to you about today are going to be familiar to you from your grade 10 work. And it really builds from one ratio to the next. As long as you understand these ratios and know how to apply them, this is a section where you can pick up a lot of easy marks. So let's have a look at our key focus for today. Firstly, we're going to focus on the need to analyze a partnership financial statement. So what we want to know is, why do we analyze a partnership financial statement? Really, if we open a partnership, what we want to do is we want to know whether or not our partnership is doing well. It's not just enough to say that we're making a profit. There are a whole lot of key figures that we can use to analyze what needs to be improved upon in the partnership, what's working well, what's working badly, and the analysis helps the partners to make informed decisions about how to carry on with the partnership. So we can say that it helps the partners to see positives and weaknesses, or positives and negatives, in the partnership, and to address these where necessary. If my business is doing well, I continue doing more of the same. If my business is doing badly, then obviously I must try to fix that mistake. I must try to put controls, or I must need to put some type of measure in place to make sure that my business improves. And when we analyze a partnership financial statement, what we usually do is we calculate ratios, which are also known as financial indicators. So you will have seen the terms financial ratios or the terms financial indicators, and we analyze them according to one of four main categories. These four main categories are the profitability of the business. In other words, am I making a profit? Am I making a loss? Is my business more profitable than it was last year? Is it less profitable than it was last year? Can I compare my profit or my loss to other businesses that sell the same product? Am I doing better or am I doing worse than them? What needs improvement and what needs to change? When we look at indicators like that, we're analyzing the profitability of the business. The second category of ratio that we analyze is what we call solvency. I'm sure you've heard the word insolvent. If somebody is insolvent, what that means is that his or her assets are less than his or her liabilities. In other words, they owe a lot more money. Their liabilities are more than what they have to pay them off. In other words, their assets. So if you've got sort of a negative owner's equity, if you owe more money than you actually have, then you are what is called insolvent, and then it is time to either close down or file for bankruptcy, or what you could also do is try and get an investor to help you out of your financial mess. So that is really what solvency is. It determines whether the business is solvent or insolvent. Then our next one, which sounds a bit like physical science for those of you that do physical science, is liquidity. It has nothing to do with solids, liquids, and gases, but what it has to do with is the cash flow of the business. In other words, is there enough cash coming in that will let the business meet its short-term debt? It's no good having a lot of assets that are worth millions of rands, but not being able to pay a creditor that comes and knocks on your door and asks for 10,000 rand in cash if you don't have the cash. So what we're looking at when we look at liquidity is we're looking at the ability of the business, or the ability in this case of the partnership, because remember grade 11s, we're doing partnerships. It's the ability of a partnership to pay its short-term debt. So sometimes a business has got a liquidity problem. In other words, it has maybe just bought something very expensive, like a new piece of machinery or a new vehicle, or it's moved to new premises in some way, and right now it perhaps doesn't have enough money to buy its stock. It needs to buy some of the stock on credit. If that happens, we say that the business is having cash flow problems because it's struggling to pay off its short-term debt. And that could be a problem for the business, and we need to manage that and take relevant steps. Then finally, we've got risk and return. Risk and return relates to how risky it would be for a potential investor to put money into the business. Is this a business that is likely to do well? Or is this a business where an investor is likely to lose his or her money? How risky is the business? And also, what is the return that the business will earn? Mindset is, when we speak about return, we speak about a percentage that your money grows over time. So for instance, if I've got a return of 9%, what that means is that 100 Rand today will be worth 109 Rand at the end of the year. So 100 Rand grows by 9%, and at the end it is worth 109 Rand. So what we do there is we look at our return in the partnership and we compare it to other investments, to other things we could be doing with our money. For instance, we could be investing our money on the stock exchange. We could be investing our money in a fixed deposit in the bank. There are a whole lot of different things that we could be doing with our money, and if we could do better investing our money there than investing it in the partnership, then maybe we should consider closing the partnership down, taking our money out and putting it into something else. Only if you know what your return ratio is, do you know whether or not it's worthwhile continuing the partnership. But we're going to be looking at these in a bit more detail as this lesson goes on. So the purpose of analyzing a partnership financial statement, we can break down into two reasons. Firstly, we want to be able to comment on the financial position of a business. When you work in a business one day, you will probably see a whole lot of annual reports where the directors of a business or where the partners in a partnership produce a long document explaining to the investors how much money they have earned, how well or how badly the business is doing. And an annual report like that requires all of these different ratios to give people an indication of whether the business is doing well or whether it's doing badly. You could think of these financial ratios as your school report. At the end of every term, you get a school report to take home to your parents or to your guardians, where they are able to see how you have done in every subject across the board during your term. Financial ratios can be used in exactly the same way to see which areas of the business are good and which areas of the business are bad. So a financial ratio allows you to comment on the financial business of the decisions, and it also allows you, as the second point, to make an informed decision on whether or not to invest in a partnership. Remember, everybody wants to make money. That's one of the key things that most people want to do when they start working. They want to earn as much money as they possibly can. So they need to make an informed decision on where to put their money. Should they put it in this partnership or in that partnership? Should they put it in the bank? And if you calculate all of these ratios correctly, or all of these indicators correctly, you will have a good indicator of whether or not to invest in one partnership or in another partnership. So you'll be able to compare different types of investments, and you'll also be able to see how well your partnership is doing over time if you compare these indicators from last year to this year. So the financial analysis can be extremely useful when it comes to deciding where to invest your money, and this is a life skill, mindsetters, that you can apply when you are older and have money to invest in a partnership. You can decide where to put your money, so it's a really, really useful thing to be able to do. So let us now look at the concepts in a bit more detail. If I want to look at the profitability of my business, what now happens if I'm looking at the profitability? I have to calculate indicators, as I've said before, to determine the ability of a business to make a profit. And there are 5 main indicators which I've got over here. There is a formula sheet in most textbooks that has the formulas for each of these. It looks something like this. So this is the ratio sheet which has all of the different indicators, and you'd be able to learn from them. And what I strongly advise you to do is to learn this ratio sheet very well. Learn these formulas, mindsetters, so that you're able to write them down and analyze them, and you will usually get 1 mark for identifying the correct formula. So for example, our first formula is gross profit on sales, which I've circled over here. And you need to know, if you get asked to analyze the profitability of a partnership, you need to know that you have to use this formula, gross profit on sales. So I cannot overemphasize the importance of learning these formulas so that you're able to understand which formula is used when. Today I'm not going to go over the formulas, they are in your textbook, but what I'm going to do is go through every indicator and tell you how you should comment on it after you've calculated it. So the first one here is what we call gross profit on sales. And what this ratio does is it tells you for every R1's worth of sales that you've made, what percentage do you keep as gross profit? So let's say the ratio works out to be 20%, or the indicator works out to be 20%. What that means is that for every R1's worth of sales that you've made, 20% of that, in other words 20 cents, goes into your pocket as gross profit. So what we want from this ratio is we want this ratio to be as high as possible, and we also would want it to increase from last year. So this is a ratio that we want to be high or increasing. Very often when you're doing a question like this, they give you last year's indicators in brackets next to the indicator that they're asking you to calculate. So when you're commenting on the ratio, you can always say, compared to last year, this ratio has increased, which means that my profitability has improved, or we can say that this ratio has decreased, which means that my profitability has declined. So a typical way of analyzing this is first to calculate the ratio, comment on whether it's good or bad, and then if appropriate, you compare it to last year. Now this second ratio is the gross profit on cost of sales. So this gross profit on cost of sales tells you also the markup that you have achieved. You'll remember this from grade 9 EMS and grade 10 accounting. We usually have a markup of some or other percentage. So let's say that it's 50% that we want to sell our stock at. So we would have what we call a target markup, and that could be something like 50%. Now, when we calculate this ratio, the gross profit on cost of sales, what happens is we actually calculate the markup achieved. In other words, the real markup that we have achieved after having made our sales for the year. So let's say that that ratio comes to 45%. So this would be our markup achieved, which is the result of this calculation. What we do is we compare this ratio to our target markup, and we comment and say, have we achieved the markup or have we not achieved the markup? So in this example, if we have a target markup of 50% and the markup that we've achieved is only 45%, our conclusion will be that we did not achieve the target markup. And if we did not achieve the target markup, what we will conclude is that there is a reason for this. Our stock has either been stolen, or we've been giving our staff, or not our staff, our customers, too many discounts, or perhaps some of our staff is taking some for personal use. We'd have to check for theft, or perhaps some of the stock is just simply being lost or being damaged in our business. So this is a useful indicator where we are able to determine whether we're giving too many discounts or not, and we're able to take some steps to rectify this if necessary. So remember, this second one is always the one that you compare to the target markup if you get given it in the question somewhere. Our next ratio is our operating profit on sales, and this is very similar to the first ratio. It tells us for every R1 of sales how much we keep as operating profit. In other words, after we have included our operating incomes and subtracted our operating expenses. So usually this ratio is less than the gross profit on sales because we've got our operating expenses to subtract, but we also want this ratio to be as high as possible because the higher the ratio, the more we get to keep for ourselves as operating profit. Our next ratio is what we call operating expenses on sales. And what we do is we take our total operating expenses, compare them to sales, and let's say we get a percentage of 12%. What this means is that for every R1 worth of stock that we sell, 12% or 12 cents is spent on our operating expenses. Now this would be a very good number because it means that we've got a lot of profit left over. Our expenses are actually quite low. But if we've got operating expenses on sales of say 60%, then that's very, very high. It means for every R1 we sell, 60 cents has to be spent on operating expenses. And what we would conclude is that we have got difficulty controlling our costs. We are not able to keep our costs down if our expenses are really high. So this is the one, the only profitability one that we want to be as low as possible. Then our final indicator here is the net profit on sales, and that really is the key indicator which tells you how much you keep for yourself after all of your expenses and all of your incomes have been considered. And the same as the previous two, gross profit and operating profit on sales, these three here that I've marked in pink here are all interlinked, and we all want them to be as high as possible, or at least increasing from last year. Usually a good rule of thumb is that we want this net profit on sales to be at least 1/3 of our gross profit on sales. So in other words, if our gross profit on sales is 30%, it means that we would want our net profit on sales to be at least 10%, because 10 is 1/3 of 30. We would want it to be as high as possible and at least 1/3 of our gross profit. Otherwise, we would have to conclude that we have got difficulty controlling our costs, we have too many expenses, and our profitability is not very pleasing. So those are our profitability indicators. Let's now move on to our next section, which is our section on liquidity. So we've said that liquidity is the ability of the business to meet its short-term commitments, and there are two main indicators here, which is the current ratio and the asset test ratio. Now I'm going to show you the formula for this first ratio, which is your current assets, which you put as a ratio to your current liabilities. And the next point that I'm going to make is very, very important for all of the ratios that have got this semicolon in between. Please make sure, mindsetters, when you're calculating your ratio, make sure that the right-hand side of your answer is equal to 1. So you have to set it out so that the right-hand side of the ratio is equal to 1. You would have done that in grade 10, but let me just give you an example. Let's say our current assets were 100,000 Rand, and let's say that our current liabilities were 50,000 Rand. You should be able to see that 100 to 50, if we have to simplify this ratio, the ratio simplifies to 2 as to 1, because 100,000 is twice 50,000. It's double 50,000. So this here is the correct way to express the ratio. You have to simplify it as far as possible so that the right-hand side is always equal to 1. Do not leave it as 100,000 to 50,000. You will lose marks for not simplifying the ratio down so that the right-hand side is equal to 1. The same thing happens if you're calculating a ratio. Let's say that the ratio, instead of being 100,000 to 50,000, let's say it was 100,000 to 200,000. So do you see that the right-hand side is double the left-hand side? So really, some people might write this ratio as 1 is to 2. But this, mindsetters, is not the correct way of doing the ratio, because we've said that it's the right-hand side, in other words, this side of the ratio, that has to be equal to 1. So when we do the ratio and calculate it correctly, it actually ends up being 0,5 as to 1. So this ratio must please, please, please be written as 0,5 to 1 and never as 1 is to 2. The reason we do that is so that we can compare the ratios from one year to the other carefully, and that we know what we are doing when we compare them and can see whether they've increased or whether they've decreased. So the current ratio and the acid test ratio really tell you whether your business is liquid or not. And you'll know how to calculate them from grade 10. You have done them in grade 10. But just remember that the current ratio tells you your liquidity, and you usually want it to be 2 to 1 or better. When I say or better, I mean that it's higher than 2 to 1, so 3 to 1, 4 to 1, 5 to 1. If we've got a current ratio of 2 to 1 or better, we will say that our business is liquid. But please be aware that some businesses might not consider it to be 2 to 1. They might be happy with a lower current ratio. It depends on what type of stock they sell. It depends on how easily they're able to get financing. But a general rule of thumb is that we want the current ratio to be 2 to 1 or better, and the acid test ratio to be 1 to 1 or better. If you're not sure about this, go back over your grade 10 work so that you understand the difference between the current ratio and the acid test ratio. We also have another category of indicators called operating efficiency. And if we want to know whether we are operating efficiently, this could also be a way of measuring our liquidity. There is a debtors collection period, there is a creditor's payment period, and there is a period of stock on hand. And these ratios all tell you how efficiently you're operating. The debtors collection period tells you how long it takes to collect your money from your debtors. And this answer is going to be expressed in days. So on average, let's say this answer works out to be 35 days. What that means is that on average, you're waiting 35 days from the day that you made the credit sale up to the point that you are receiving the money from your debtor. So you would want this period to be quite short, because you need to get your money in from your debtors quite early on average, because that money can then be used to continue running your business as working capital. Creditor's payment period is the opposite. It tells you how often on average, or how long on average, it takes you to pay your creditors. And it's also expressed in days. So let's say that this answer comes to 60 days. What that means is that on average, we pay back our creditors every 60 days. And to determine these two ratios or interpret them, what we should always do is compare the debtors to the creditors period. So let's say we've got 35 and 60. We are getting our money from the debtors every 35 days. We're paying off our creditors every 60 days. What that means is we're able to use the money we get from the debtors to pay off our creditors. We get it in time to be able to pay off our creditors. But let's say that it was the other way around, and let's say that we had a situation where the debtors collection period was 60 days and the creditors payment was only 35 days. What that means is that we are waiting on average 2 months, 60 days, to get our money from our debtors, but we're paying back our creditors at the end of every 35 days. So we don't have the money yet from our debtors, because we're waiting until 60 days are over before we get it, but we have to pay the creditors now. So what that means is that we have to dig into the cash in our business and take out of our bank account to pay our creditors, and we would then conclude that we might have a cash flow problem. So compare the two, and always make sure that the debtors collection period is less than the creditors payment period. Then our final one in this section is the period of stock on hand. And what this tells you is how long, on average, you keep your stock on the shelves. And this ratio can be very different depending on the type of product that you sell. If I'm a cafe that sells groceries and fruit and vegetables, I want this to be low, and I want it to be maybe every 14 days. I don't want to keep my milk and my bread and my eggs on the shelf for longer than 14 days on average, because they're going to go off. People are not going to want to buy them anymore. So very importantly, the period of stock on hand, you have to relate this to the type of product. And different products are going to have different good periods of stock on hand. So that is your operating efficiency. Our next category of ratio is what is called the solvency ratio. And there's only one ratio here, and it's also called the solvency ratio. It's total assets to total liabilities. I'm not going to go through it in detail because it's usually the first ratio that everybody learns in grade 10. But remember that this ratio needs to be 1-to-1 or higher for us to conclude that the business is solvent. So the minute this ratio drops to less than 1-to-1, what that means is that our assets are less than our liabilities, so maybe 0.5-to-1. What that means is that for every one liability we have, or every 1 rand's worth of liabilities we only have 50 cents of assets, and we are basically insolvent. We need to somehow get somebody to invest money into our business so that we can afford to pay off our liabilities. And then we have 2 more that I'm going to go through quickly. Firstly, we have the return ratio. The return ratio tells us how much the partners are earning from the business. This is the same ratio as the return on capital that we had in grade 10. It's the same as the return on capital ratio, and it just works out a percentage and tells you how much the partners are earning from the business. And we want this to be as high as possible. And what we do with this ratio is we compare it to other investments. So if I'm deciding what to do with my money, I can decide to put the money in the bank. And let's say I could put it on a fixed deposit, and a fixed deposit pays me 8% interest. That's what I could get from putting my money in the bank. If I then calculate the return on equity in the partnership, that tells me how much I'm earning if instead of investing the money in the bank, I've invested it in the partnership. And let's say that that comes to 10%. So I'm just going to put here partnership, 10%. That is greater than what I could do if I invested the money in the bank. So as a result, it is better for me to put the money in the partnership than in the bank. So you always want this ratio to be better than other investments if possible, because that is a sign that your partnership is earning a lot of money. The same goes for the return earned by each partner. The only difference is the return on equity, you take the money invested in total in the business, so by all the different partners. Whereas the return earned by each partner is the partner's own capital and how much money he or she is earning from his or her investments in the business. So you would take the salary of the partner plus the interest on the capital plus the share of the net profit, and that is the partner's earnings, and you would divide that by the partner's investment. In other words, the capital and current account of the 2 partners. You would again interpret this the same way and see whether the partner is doing better or worse than they could have done by putting their money into the bank or investing it somewhere else. So our last indicator here is our risk indicator. And risk tells you whether or not your business is creditworthy. In other words, can it borrow money if it urgently needs money? And the way we do that is we calculate the debt-equity ratio. So the debt-equity ratio, when we calculate it, we want the ratio to be low if possible. We want it to be around 0.5-to-1. What this means is that for every 1 rand that the partners have invested in the business, that's the equity, there are 50 cents worth of liabilities. In other words, for every 1 rand we owe, we have 50 cents worth of debt. And the higher this number is, the less creditworthy the business becomes. So let's say that we calculate a ratio as 3-to-1. What this means is that for every 1 rand that the business for every 1 rand that the business has invested from its partners, it owes 3 rand in liabilities. So do you think that the bank would lend the partners money if they already owe 3 times as much as what they've invested in the business? I don't think so. The bank really would not do that. What this means is that you have a high ratio like this, anything higher than 1-to-1, you would conclude that the business is not creditworthy, and we would then also say that the business is risky. You must try and stay away from this business because this business has got a lot of borrowed money. So the last 3 hints that I'm just going to give you before we look at a practice question are the ones that I've said before, but they're worth repeating. Remember that the right-hand side of the ratio is always equal to 1, as I showed you earlier. Also make sure that you read the full question and round off to the number of decimal places that is indicated in the question. Some questions want only 1 decimal place, some questions want 2 decimal places. Make sure you round off correctly. And then this last one, which I'm going written in big bold letters here, learn your formulas. Learn them well. Make sure that when you're asked to calculate a ratio, you use the correct formula for that particular calculation. So that was the theory, and we're going to go on to trying a question now, but I think that you've worked quite hard and deserve a break, so we'll see you in a few minutes. After the break, we'll do a practice question. Welcome back, Mindsetters, to Accounting Grade 11 Learn Extra show, where we're discussing the analysis of partnership financial statements. Before the break, I went over all of the different types of financial ratios and financial indicators that you need to calculate in grade 11 to be able to analyze a partnership and the statements. Now, we're going to go through a typical exam question where we're looking at a published financial statement of a partnership, and we're analyzing it by calculating the various indicators and the various ratios that are necessary to determine whether the business is doing well or badly. Now, what's very important to realize is that in an exam situation, it's going to be impossible for us to ask you all of the many different ratios that you need to know and that you need to study. But we could ask you any one of them. So if you look at the formula sheet here, there are quite a few financial ratios. You can see the formula sheet is full of different ratios, and unfortunately, you have to learn every single one of them together with the appropriate interpretation so that you're able to answer whatever the question is asking you. The good news, though, is that all of these ratios stay the same for your matric accounting, and you only learn about 5 or 6 extra ones that are relevant to companies that you're going to be doing in grade 12. So when you're doing this, you're already preparing for your final exams at the end of your school career. So I would advise you spend a lot of time learning these ratios. Give yourself some hints and some clues as to what they mean, and make some good notes that you can study from to jog your memory, because there are a lot of them, but once you've learned them, they're very easy to apply and they're very easy to implement and get marks in the question then. So let's look at now a typical exam question. So here's the information sheet, and it tells us that this business is called Pick and Spar, and it is a partnership between the two partners, Esther Souza and S. Rodriguez. You will remember from your theory that a partnership is allowed to have 2 to 20 partners, but usually in your grade 11 accounting you only do partnerships with 2 partners, because otherwise your accounting gets quite complicated. This business has been in business for the past 10 years, so they're an established business, they're doing quite well. And they are a retail trader. Remember from grade 10 accounting that a retail trader is a business that sells products instead of a service provider which provides a service for you. And they are the only grocery shop in an upmarket and growing shopping center. This shopping center is also located near a newly developed golf estate. So this business is in a place where they are the only grocery shop. If people want to buy groceries, they have to come there, otherwise they have to travel a bit further. So for those of you that do economics, you will realize that that is also a good thing to be the only store in a particular area, because then everybody is going to have to come and buy from you. Think about it this way: if there was only a Vodacom signal in the area where you live, every resident of your area would have to be on Vodacom. So it's a big advantage to be the only grocery shop or the only store of its kind in a particular area. And they are also located near a newly developed golf estate. Remember, newly developed means that there are more people coming to live in that area, so they can expect that in the future their profits are going to rise. Now what we've got here is the following information that is extracted from the business's financial statements. So you'll remember that our main financial statements are the income statement and the balance sheet. And what you'll also perhaps know is that there are alternative names for these two income statements and balance sheets, which you might sometimes encounter when you're looking at a real business. Sometimes the income statement is known as the condensed consolidated statement of comprehensive income. So if you go onto the internet and want to do this for a real company and analyze a company to decide whether or not to invest in it or whether the company is doing well, you might sometimes see different names for the items that are familiar to you. But the format is exactly the same, because if you look at this condensed consolidated statement of comprehensive income, you will see that it starts with sales and it starts with cost of sales and then has gross profit. So it's exactly the same as an ordinary income statement. Don't let the name of it fool you, because you will sometimes get different names for the same object. So this is our income statement basically, and you can see that they've given it to us for 2 years, in 2012 and in 2013. So we've actually got last year's figure that we could use to compare whether the business is improving or whether it is declining. And if we look at it immediately, we can already see, if we compare 2012's gross profit to 2013's gross profit, it looks as if the business is making a higher profit than before, because it's gone from 1.1792 million to 1991 million. So it looks as if the business is already benefiting from the new developments in the area. But we need to do a further analysis and calculate the relevant figures to be able to comment properly on the financial statements. Now, our balance sheet also sometimes has a new name, which is called the statement of financial position. So remember, when you see a financial position statement, that's the same as your balance sheet. Most textbooks, usually when they are discussing a balance sheet, say that a balance sheet shows you like a snapshot or a photograph of your business on a particular day, and it explains the financial position of that business. And we've got here our section on assets, and we've got our section on owner's equity and liabilities. So really, we've got our two important financial statements that we need to analyze, and it looks like we've got most of the information necessary to calculate all the ratios that they can ask us. So let's see what they're asking us. The first question says, make use of the relevant ratio and percentage calculations to provide supporting evidence to your answers. So we're going to calculate whichever ratio is relevant, and we're going to provide evidence to support what our answers are. And it's shown us here that the calculation mark plus the comment mark equals the total. So we're going to get marks for calculating the correct ratio, and then we're going to get marks for our comments. So we need to make sure that our comments are clear and that they relate back to the answer that we've calculated when we have worked out the ratio. It also tells us that all calculations must be for the year ended 31st of May 2013, unless otherwise stated. So we're looking at the 2013 balance sheet. Make sure that you read the instructions of the question carefully so that you know which year we are analyzing. So our first calculation is that we have to calculate our solvency ratio. First question, relatively straightforward one. Calculate the solvency ratio and comment. And you can see they've allocated 2 marks for the calculation and 2 marks for the comment. Now, once again, if you don't know what the formula is, you're not going to be able to do it. Let's look back at our formula sheet and see which ratio is the solvency ratio. Here's our full formula sheet, and you will see it's this one over here that I'm circling. Total assets to total liabilities is your solvency ratio. So it's expressed as a ratio of total assets on the left, total liabilities on the right. Let's go back and write that ratio down for our question. So we're going to calculate total assets as a ratio to total liabilities. In grade 10, you usually got a mark for writing the ratio out. You don't always get it in grade 11, but sometimes you do. It's worth writing it out so that you know which figures to use. So we need our total assets on the left-hand side. And if we look back to our information sheet, we will find our total assets somewhere here. We need to go to our statement of financial position. Here it is. Total assets, and remember mindsetters, we're doing it for 2013. Total assets is 2032,000. So let's write it in here. $20,32,000 are our total assets. On the right-hand side, we need to have our total liabilities. So if we look back at the information in the question, the information tells us that our total liabilities are found somewhere here. We need to look in our balance sheet section, and we will see there that we are not given our total liabilities. All we are given are our non-current liabilities and our current liabilities. We're not given a section at the bottom that says total liabilities. What we are given is total equity and liabilities, but remember that this total includes your owner's equity as well, so that's not the total that we want. To calculate our total liabilities, what we're going to do is take our non-current liabilities of 525,000 plus our current liabilities of 507,000, and let me just get the calculator up here. So our non-current liabilities were 525,000 over here, and our current liabilities were 507,000. If we add the two together, we're going to get our total liabilities of 1,032,000, and that is the number that we're going to write down in our calculation. So on the right hand side, we're going to write down our 1,032,000, that is our total liabilities. Okay, so now we're ready to calculate our solvency ratio, and the way we do that, we've got a ratio of 2032 is to 1032, but remember the important point that I made, that the right hand side of the ratio has to be equal to 1. So the way we do that is we divide both sides by this orange figure here to cancel it out on the right hand side, because you know that 1032 divided by 1032 is going to give you 1 on this side. And on the other side, we're going to do the same. We're going to divide it by 1,032,000, and we're going to express the answer as a ratio. So if we do it on the calculator, so we're going to take our total assets, which is 2032,000, divide by our total liabilities, which is 1032,000, and the answer comes to 254 over 129, which we will change to a decimal by pressing the S to D key, and the answer comes to, let's round it off to 2 decimal places, 1,97. So let's fill it in here. The answer comes to 1,9721. So we get 2 marks for that calculation, calculating the solvency ratio correctly. Now the next part of our question requires us to comment on the ratio that we've calculated. So remember, when we looked at the financial ratios earlier, I said to you that this solvency ratio has to be 1 to 1 or higher for the business to be solvent. And right now it is 1,97 to 1. It means that we've got 1 Rand 97 in assets for every 1 Rand of liabilities that we have. So if we had to comment on this ratio, we would say that the business is solvent. Solvent meaning that it's not bankrupt, it can afford to pay off its long-term liabilities, it's got enough assets to cover its liabilities, and we would have to say, because the solvency ratio, I'll just abbreviate it as SR, is greater than 1 to 1. So that's enough comment to get the 4 marks for this question. You have to remember, when you're doing the calculations, it says that you have to provide supporting evidence and give an answer, say whether, or say what the ratio actually shows you. And right here, this ratio is showing us that the business is solvent. Why is it showing us that the ratio is solvent? Why is it showing us that the business is solvent? Because the solvency ratio is greater than 1 to 1. So that is where you would get your 4 marks for this question, 2 marks for calculating it correctly, and 2 marks for analyzing it and saying whether it's solvent or insolvent and why. Okay, let's have a look at our next question. Our next question says, Pick and Spar have the option of spending their cash on inventory and stockpiling for the festive season. In other words, they've got the option of buying a whole lot of stock. If you see the word stockpiling, what that means is that you buy as much stock as you possibly can. So they're stockpiling for the festive season. In other words, the Christmas holidays. But they've got another option. The second option is to simply retain the cash in the business. So they've got a whole lot of cash that they want to spend. We can actually see how much cash they have if we look back at our partnership financial statements. You can see here that they have cash and cash equivalents. This here tells you how much cash is in the business. They actually have 315,000 rands worth of cash. In other words, in their bank account and cash flows and petty cash and so on, there's 315,000 rands worth of cash that they are able to use to buy stock if necessary. Now, they want your advice as an accounting expert. They want to decide whether to spend their cash on inventory, in other words, buy a lot of extra stock, or retaining it in the business. And the partners are divided. Partner Esther Souza wants to stockpile because she believes that this will allow them to sell more over the festive season. We know what happens at Christmas time. People want to give each other gifts and so on. People are often on holiday and they get an extra bonus for December, and they want to spoil each other by giving each other gifts. So she thinks that this partnership will be able to sell more stock over the season. However, the other partner, Partner Es Rodriguez, believes that the partnership should keep its cash. Es Rodriguez has asked you to briefly mention 2 disadvantages of stockpiling and 2 reasons as to why they should keep the cash. So they're asking you to take the side of Es Rodriguez and saying that whether the business should keep cash. So we have to kind of say why the other partner is wrong, provide 2 disadvantages of stockpiling, and we have to provide 2 reasons as to why they should keep the cash. So here's our little block in which we should put the answers in. First of all, let's think about the disadvantages of stockpiling. What would be the disadvantage of keeping a whole lot of stock on hand? Well, one of the problems might be that you don't sell all the stock. So that could be a problem, because if you don't sell all the stock, you could end up losing quite a bit of money because you've bought it now and maybe you can't return it to the supplier. So let's put that down as one of the disadvantages. The business might not be able to sell all its stock, therefore losing money. I'm sure you've seen that sometimes if you walk through a shopping center or a mall or something, you sometimes see those posters up which say sale 25% off all stock or 50% off all stock, because this business doesn't want to keep its stock much longer and it realizes that it needs to sell the stock out fast. They might give you a big discount to be able to get rid of the stock. Another big disadvantage here, if you think about what type of business this is, if we go back to the information, we remember that this business is a grocery store. It is a grocery store. And I don't know about you, but usually at Christmas time, I don't really buy people groceries for Christmas gifts. I usually buy other things, other more durable items. So it's not necessarily to say that they're going to sell more groceries if people buy them to give each other as gifts. But on the other hand, people often throw big parties during the holidays, which means that they might need a lot of stock to entertain, a lot of food, a lot of drinks, and so on and so forth. So there could be a disadvantage that because they are a grocery store, there's an extra disadvantage that the stock that they keep on hand might go stale or might go bad. The nature of the stock is such that if they don't sell it, the stock is going to go bad. So let's put that as the second point. The stock might go stale before it is sold. Because the stock is groceries. Obviously, that's not going to happen to something like a cell phone. If a business buys many cell phones, the cell phone can't go bad. It can be kept in the box until it gets sold. But the disadvantage in that case, if this business were a cell phone provider or anything that produces technology, the stock doesn't necessarily go stale, like it doesn't go bad like food does. But what does happen is that it becomes outdated and obsolete. You'll know that people are always upgrading their cell phones when they can, because new models come out, better models come out. So that might be a disadvantage of keeping stock if this business was not a grocery store, but instead was like an electronics store or something like that. So now let's think about The other side, we've said the disadvantages of the stockpiling for the one partner's position. And now let's think about the reasons to keep cash in the business. Why do people keep cash in a business? Why do they keep it on hand instead of spending it? Well, one possible reason is that the business needs cash to continue operating in the future. Businesses always need cash on hand to be able to pay for things, pay for salaries, pay wages, and so on and so forth. So continue operating in the future, pay wages, and maybe it even wants to expand or something like that. So very often a business might have plans to do something big, maybe go on a big advertising campaign to try and increase its profits, maybe open another shop somewhere. There can be a lot of reasons as to why a business might need cash, and those would be reasons to keep cash to take advantage of opportunities that allow us to grow or expand in the future. But another very important reason to keep cash in the business is for safety measures, in case something goes wrong. In case some stock is lost, in case some stock is stolen, in case the business has to suddenly replace something that breaks in the business. For instance, imagine that a computer or a big machine or something in the business breaks down, the business might need to replace it. So sometimes we could say that the business needs cash for emergencies or to replace damaged equipment, might be an example. Now, I want to stress mindset is that this question is an open-ended question. Often when we're doing a question on analysis, you can give a whole lot of different answers provided that they make sense. You see here that we actually didn't have to calculate a single ratio, we just had to think of some possible advantages and some possible disadvantages. And if you can think of another reason to keep cash or another disadvantage of stockpiling, you don't have to use necessarily my answers. My answers are suggested answers, but the chances are that if you can come up with another good reason for not stockpiling or keeping cash, the examiner is going to look at your answer, and if he or she agrees with it, you're going to get the necessary marks. So remember that there are often different possible answers that are acceptable for a question. As long as it makes sense and is logical, the examiner will mark it and give you the marks that you deserve. Right, so let's look at our next question now. Our next question says, the partners are concerned that they are not selling goods fast enough and that their stock is going stale. Is this the case? So they want to know, are they selling their goods fast enough or is their stock going stale? Notice that this question hasn't told you what ratio to calculate, but there's 3 marks here in the mark allocation allocated to calculating this ratio and 2 marks for the comment. So what you need to do is know what the relevant ratio is. Most of the time, the question is not going to be as easy as the first question where they tell you calculate the solvency ratio. Most of the time, they're going to give you a situation that you have to analyze and comment on by giving the correct ratio that's relevant to the question. So the normal ratio that we would use here is the period of stock on hand. There's another ratio that you will see in the textbook that is very similar to this one, which is called the stock turnover rate. I'll just write this here for you. I didn't go over that one, but it's very, very similar to the period of stock on hand. And if you've calculated one, you can use it, or you can use the stock turnover rate, which is sort of the inverse of that ratio. So I'm not going to discuss the stock turnover rate today, but make sure you can calculate either one of these 2 ratios. I prefer calculating the period of stock on hand because to me it is easier to interpret. So this is the one that I'm going to use. Now, if we look back at the formula sheet, the formula sheet has got the ratio that we need, and it is this one over here. It's our average inventories over cost of sales times 12, or you can also use the ratio times 365. Both answers are acceptable. most textbooks publish both of them. This one that I've got has got times 12 over 1. I'm going to do it times 365. If you do it times 12, it gives you the number of months, because there are 12 months in the year. If you do it times 365, it gives you the number of days, because there are 365 days in a year. So I'm going to use that one, which is average inventories over cost of sales. Let's write it down on our page. Average inventories over cost of sales. And I'm going to multiply this answer by 365. I prefer to do it times 365, but please note that it is not wrong to do it times 12. You can do either one that you'd like. So now, of course, to do this, we have to find the figures. So let's go back to our information sheet that we have here. And we're looking at the average inventories at the top and the cost of sales at the bottom. Here's our cost of sales figure, 2.25 million. That's our cost of sales for the period 2013. So that's the one that I'm going to put on the bottom of the denominator. 2250000 is our cost of sales for 2013. Let me write that down so long. So at the bottom we have 2250000. At the top, we have average inventories, and the word average is important. You know, if you're trying to calculate your average for 2 tests, you add the 2 marks together and divide by 2. We're going to do the same for average inventories by adding the inventories from 1 year together. So it's going to be the inventory from 2012. We're going to add that to the inventory from 2013 and divide it by 2. Whenever you see the word average in a question, what you need to remember is that you're taking this year plus last year, add the 2 together and divide by 2. And this comes up in surprisingly many calculations that you need average inventories. So if we go back to our balance sheet over here, we need to look for our inventories figure. And we can find our inventories figure in the balance sheet is 240,000 for 2013, and for 2012 it is 210. To calculate our average inventories, what we must do is we have to add these 2 together, and the total we have to divide by 2 to get what our inventories were on average during the year. This is very important because it shows you how your cost of sales were spread over the year. But I just want to tell you that if you get a question which doesn't have, let's say the question didn't have the 2012 figures at all, and it just gave us the 2013 figures, then it is possible just to take the 240,000 and then just put that at the top of the ratio that you're calculating. But if you've got both years, the question will expect you to calculate the average inventory. So let's do that quickly. To calculate my average inventory, I need to take my 240,000 for 2013. Then I need to take my 210,000 and add it for 2012. It gives me a total of 450,000. And if I divide that answer by 2, that gives me my average inventories of 225,000 Rand. So let's put that on our answer sheet. At the top, I need 225,000 Rand. And I'm going to multiply this answer by 365 to get the number of days. So let's do that. I have 225,000 on the top. The number's already in my calculator. I'm going to divide it by 2250000. Please count the number of zeros correctly so that you don't make a mistake. And the answer I'm going to multiply by 365 to see what the answer is in days. Take 73 over 2, convert it to a decimal. I get 36,5 days, which is the answer to my question. Let's write it in here. 36,5. Remember to express this in days. So what have we actually calculated here? We've calculated the period of stock on hand, and the period of stock on hand tells us that on average, this business, Pick n Spar, sells out its product every 36.5 days. So it means that on average, an item of stock is on the shelves for 36.5 days. What do you think about that? Would you go to a grocery store where you know that the average length of time that that product is spending on the shelf is 36.5 days? I wouldn't, because I would suspect that much of the stock is old and is going stale. And remember that the question we were asked previously is, are they selling their goods fast enough, and is their stock going stale? They were concerned about that. Perhaps they've had some people coming to complain that they've bought items of food or items, some drinks or groceries, and that those things taste stale. And we've actually now got proof with this calculation that on average the stock is staying on the shelf for 36.5 days. So if we had to now comment on this, by the way, the mark allocation, you'd get 3 marks for the calculation, 2 for calculating the average inventories at the top, and then 1 mark at the bottom for including this ratio and calculating the right answer. So what we need to now do is comment for 2 marks, and the question said, are the partners correct? Is this the case that the stock is going stale? So we would answer yes, the stock is going stale. Okay, and then to motivate it, we have to say something along the lines of 36.5 days is too long for stock to stay on the shelf in a grocery store. When calculating this when calculating this ratio, you have to refer to the type of business. In a grocery store, this is certainly unacceptable. It would also be unacceptable in something like a magazine store that sells, or a newspaper store which sells a newspaper every day. You can't keep an old newspaper on the shelves for 36.5 days. But this might be acceptable for a technology store like a cell phone store, because every month new cell phones are coming out. So very important is to relate this to the type of the business, as I said previously when I discussed this ratio with you. So to get full marks, you have to answer the question, the stock is going stale, and refer back to the ratio and the type of business that is being used. So let's have a look at our next question. Our next question asks us to comment on the gearing. In other words, the debt-equity ratio of the partnership. Here they've been kind to us. They've told us that we have to calculate the debt-equity ratio. And once again, it's a ratio that you need to know. If we go back to our formula sheet, you should remember that the debt-equity ratio is the ratio that relates our non-current liabilities to our owner's equity. So that is going to be this ratio over here, non-current liabilities as a ratio to owner's equity. So let's put that as the answer to our question, or sorry, as the first formula to our question. Non-current liabilities, which I'm just going to abbreviate here to save time as NCL, to owner's equity. Okay, so non-current liabilities to owner's equity. And in this case, we're dealing with a partnership, so we need the owner's equity of the partnership as a whole. And what you should remember from when you did the partnership ledger accounts, the owner's equity of the partnership is equal to the capital accounts plus the current accounts of the two partners, is what has been put in as capital, as owner's equity for the business. So let's see if we can find those figures. Remember, we need the non-current liabilities on the left, the owner's equity on the right. If we go back to our balance sheet, which is over here, we can see that the question has given us our owner's equity. So let me highlight that for you. Our owner's equity is an easy number to remember. It's 1 million rand. Remember, we're doing this for 2013. And our non-current liabilities are given to us as 525,000 rand. Here are our non-current liabilities. So the question is, we don't have to calculate the sum of the capital and current accounts, although you should be able to see that if you add this 850 plus this 150, it gives you the total owner's equity at the top. And the question's also given us the non-current liabilities, which is made up of this loan at 12% from ABSA. They come to 525,000. Make sure you remember what is meant by a non-current liability. Remember, that is something that we're paying off over a long period of time. So this 525,000 Rand needs to be paid off for a period of longer than a year. So this is the figure on the left is our non-current liabilities, 525,000. The figure on our right is 1 million. Let's put the figures in to our answer sheet. Non-current liabilities on the left were 525,000. Owner's equity on the right-hand side of the ratio is 1 million. But remember, we cannot just leave the ratio like that. We won't get full marks if we just leave the ratio like that. Remember that we have to simplify it so that the right-hand side must equal 1. The way we do that is we're just going to divide both sides by the right-hand side, which is 1 million. On the right-hand side, 1 million divided by 1 million is 1. On the left-hand side, we need to get our calculator out. And we're going to take 525,000 divide by 1 million. Answer comes to 21 over 40, which as a decimal is 0,525. So we can list that here as 0,525. Just round it off. Well, it's only 3 decimal places. Let's leave it as 0,525 as to 1. So that is our debt equity ratio of the business. Now we have to comment on the gearing of this business. In other words, how much debt is there for the equity that the owners have invested? This ratio tells us that. It tells us for every 1 Rand that the partners have put in, there's debt of 52.5 cents. So for every 1 Rand that the owners have invested, they owe 52.5 cents. So they are able, their investment is 1 for every 50 cents that they owe, which means that they've actually got double what they owe in equity in the business, and this is a good thing. Remember, we said when we went through the ratios that 0.5 to 1 is a good ratio for this gearing ratio, because it shows that the partners have taken out a loan, but they are able to pay it back quite easily because the equity that they have invested in the business, in other words, the capital that the partners have put in themselves, is more than enough to pay off that loan. So what we would do here is we would comment on the gearing of the business by saying that the gearing ratio is good, and we refer to it as 0.525 to 1, which means that the business is positively geared. In other words, the business is creditworthy, because they could still go to the bank and borrow more money because they've only borrowed about 50 cents for every Rand that they've invested themselves. The business is creditworthy and the risk is low. So it's not, they do have some liabilities, but they're going to be able to pay them off quite easily because the equity that they've invested in the business is enough to pay that off quite easily. So make sure you understand this debt equity ratio. Remember, we said that we don't want this ratio to be too high. Another way of looking at this is to think about the fact that for every 1 Rand the owners have invested in the business, there's 50 cents that they owe. So actually, they've put in double their own capital than what they've borrowed. So for every 1 Rand they've borrowed, they've actually themselves put in 2 Rands worth of capital. So this business is quite safe. They're going to be able to pay off their non-current liabilities quite easily because the owners have invested enough equity to be able to do that. Let's look at the next question. So our next question is the question relating to credit policies. And it tells us to determine the credit policy of both the partnership and its suppliers. So if we're determining credit policies, what we really need to look at is those 2 ratios that relate to the debtors and to the creditors. Remember, the partnership, if we're doing the partnership's credit policy, we want to know what credit terms the partnership extends to its debtors. So what we would be able to calculate here is the debtors' collection period. And if we're looking at the policy of the suppliers of the partnership, the suppliers to the partnership are their creditors. So we are going to look here at the creditors' payment period. So those are the two ratios that we need to calculate to answer this question. So the policy of the partnership in terms of credit is going to be the debtors collection period. Let's go back and check to see if you remember the formula for it. On our formula sheet where we have all the formulas, you'll be able to spot the relevant ratio. That ratio is this one here, the average debtors over credit sales times 365. That's the debtors collection period. And here on the other side, while I'm on this formula, the average creditors over credit purchases times 365 is the creditors payment period. So these are the two ratios that we're going to use. Let's do the debtors collection period first. So we need average debtors. I'll just do it in the same color that I used there. Average debtors over credit sales times by 365. And the creditors payment period, if we do the calculation, that is going to be average creditors over credit purchases times by 365. Okay, so let's do the debtors collection period first. Remember that at the top we need average debtors. So our average debtors we're going to find in our balance sheet here as our trade and other receivables. You can normally use, if you don't have all the information, you can normally use trade and other receivables as your average debtors, because remember, debtors control makes up a big part of trade and other receivables. So to work out our average debtors for the figure that we need at the top, we're going to take our trade and other receivables for 2013 and our trade and other receivables for 2012 and add them and divide by 2 to get the average, in exactly the same way we did our average inventories when we were calculating the other ratio. So to do the calculation, we're going to get the trade and other receivables from 2013, which is our 167,000. And we're going to add the trade and receivables from 2012, which is our 194,000. And we're going to get the average, which means that we're going to divide it by 2. The answer here comes to 180,500, and that is going to be the figure that we need to put in at the top of our ratio. So if we're doing the debtors collection period, our average debtors for the year was 180,500. Let me just write it in here, 180,500. That is our average debtors for the period. And now we need to divide it by our credit sales. So if we go back to our information, we need our credit sales, which is, we need to look at our sales for the year, which is 4,241,000. And then what we must remember is that it tells us that 70% of all sales are for cash. If 70% of all sales are for cash, what that means is that 30% of all sales are for credit. So if we want to know what our credit sales are, what we need to do is just work out 30% of this figure over here. In other words, 30% of 4,241,000. So let's do that. 30%, in other words, 30 over 100, or you can use the percent sign, whatever you feel comfortable with, multiplied by 4,241,000. That tells me my credit sales for the year, and my credit sales for the year is this figure here, 1,272,300. So let's write it at the bottom of the ratio, 1,272,300. And that figure we're going to multiply by 365, and that comes to, if we put it in the calculator, it's going to be 180,500 divided by 1,272,300. The answer times by 365, and that figure comes to 51,78 days. Let's just round it up to the nearest day as 52 days. So the debtors collection period is 52 days. If we have to do the creditors payment period, we're going to do exactly the same, except we're going to use average creditors and put it over credit purchases. So if we go back to the information here, we need our average creditors at the top. So we need to go and look at our trade and other payables. And our trade and other payables we see at the bottom here. Trade and other payables are 457,000 as opposed to 511,000. We need to work out the average. In the same way as we worked out the average debtors, we're going to add them together and divide by 2. So let's get the calculator on the screen. We will take 457,000, in other words the figure for 2013, add that to 511,000, which is the figure for 2012. The answer we're going to divide by 2, and that gives us average creditors of 484,000, which we're going to put at the top of our ratio. Let's just write it in so long. 484,000. And we're going to divide that by our credit purchases. So when you're looking at credit purchases, we need to look at not our sales, but actually our cost of sales, because we assume that the business maintains a fixed stock level. I'm not going to explain that today, but there'll be a session on periodic inventory where you'll know about the fixed stock level. What we do is we look at our cost of sales for the period, which is 2.25000, and we need to work out that is the stock that we've sold, which we assume that we've bought back or repurchased, and it says 50% of stock purchases on credit. So if we want to have our credit purchases, we need to work out 50% of the figure that I've underlined in green over here. So let's do that on the calculator. We're going to need 50% times by the 2.25 million, which gives me my credit purchases of 1,125,000, and let's fill that in our space here. So that is our denominator of the fraction, 1,125,000, and we'll multiply that by 365. Let's do that on the calculator. $484,000 divide by 1,125,000, and the answer we're going to multiply by 365 to see how many days we have, and the answer comes to 35322. It comes to 157 days. 157 days. So what this means, this is quite a high one, 157 days. What this means is that this business is receiving cash from the debtors every 52 days and paying the creditors back every 157 days. So they're almost waiting 2 months before they get all their money back from their debtors, and then they're waiting quite a significant amount of time. 157 days is actually 5 months before they're paying off their suppliers. So they are able to use the money that they get from their debtors to pay off their suppliers, but if they wait that long to pay off their suppliers, one of the big disadvantages is that the suppliers might want to charge them interest. So what you need to do when you comment on this, there were 6 marks for the calculation and only 1 mark for the comment. So it's enough to say that the debtors collection period is less than the creditors payment period, which means that the business is able to collect its money from the debtors and pay off its creditors in time. Mindsetters, we've reached about the end of today's show. Please make sure that you understand all of the different ratios, make sure you know how to apply them and to analyze them, and make sure that you can write good and decent comments. Obviously, in an exam question, we can only do 2 or 3 ratios in a question that we give you, but you need to make sure that you are able to calculate any or all of the ratios and give the correct comment about the indicator that you've calculated to make sure that you can answer any question that we can throw at you. We'll see you again next time. Good luck and goodbye.